Let's welcome on board Mahendra Kumar Jajoo, the CIO at Fixed Income, Mirae Asset Investment Managers, and figure out what he's making of this mayhem right now. Good to have you on the show, Mahendra. Thanks for your time. Just wondering whether fixed income, Mahendra, can be that lone survivor and the sort of knight in shining armor, if you will.
Well, that is usually the case. I think there's already demand from the president for the Fed to cut rates. In India, we are already seeing the trend of the easing by the Reserve Bank, and in the last policy, they had cut rates, and in the next policy, which is scheduled for the current week, market is expecting another rate cut. So, fixed income on its own is in a reasonably solid space. The bond funds have been giving good return, but whether it can, substitute for anything else, I'm not the one to comment. But I think for fixed income, the things look reasonably steady and promising for now.
That you say that. You were talking about as to how a lot depends on of course, which way the world liquidity moves, what happens to yields. But seems like the RBI could go in for a rate cut, especially now, post the tariff regime by the US. Wanted to understand which way do you think the yield curve is going to move?
So over the last 1.5 years, the bond yields have fallen significantly. At this point, we have the repo rate at around 6.25%. So if you assume two more rate cuts from the Reserve Bank, one in the coming policy and one in the forthcoming policy, and look at the terminal repo rate of 5.75%, 10-year yield is already at 6.5%. So I would personally think that the 10-year yield is already richly valued, and therefore the most of the momentum in the bond funds is, I think, behind us. Having said that, it is very clear from the disruptions that are happening in the world economy that most of the global central banks will have to continue to be accommodative and step it up. My personal expectation is that Fed will switch to quantitative easing from quantitative tightening now in the next 3 to 6 months, and the interest rates will have to come down. So there is a lot of potential still there. But if we look at the historical valuation metrics, then I would think that at this point, fixed income is still very attractive, and we are expecting interest rates to come down. But at the margin, the momentum is likely to be slowing down. So one has to be a little cautious from these levels, but still expecting the Reserve Bank to cut rates, inject liquidity, expect the same pattern the world over, and therefore the fixed income space to continue to look very promising.
Let's understand what happens to the environment. So crude comes down, Reserve Bank of India will cut rates, Fed will cut rates. So are we in a situation where suddenly bonds will look more attractive than equities for next 1 year?
Well, bonds are looking attractive. I don't know whether there is a relative comparison that I can talk about with equity, because I think I've been watching your program, and there is a lot of there are a lot of possibilities. For example, the tariffs may be deferred, and some of the countries may agree to negotiate with US, etc. So for on the equity side, there are too many moving parameters right now, and things can shape up in either direction. But from what's happening, it is very clear that there is going to be a very significant amount of disruption, and there will be resetting of the world trade order in the next 1 year. So there is going to be a lot of volatility. And when there is volatility and uncertainty, I think the recent experience is that the central banks have to do the heavy lifting with the commodities prices in general on the easing side, and with crude in particular, as you said, now settling at somewhere close to $65 for now, with dollar continuing to showing the weakness, it is possible that in rupee terms, the crude oil is still cheaper than equivalent of 65 at dollar index of 100. And so I think the setup is very, very positive for fixed income. The only point I was making is that the valuations are also a little bit on the rich side because bond markets have been expecting that possibility of a Reserve Bank rate cut and liquidity injection. Especially in the last couple of months, Reserve Bank has stepped up in a very big way. So one has to be also balancing it with how much pricing in of those movements have already happened in the fixed income market.
Okay. So, do you see that in the medium term, a strong policy action will be now taken, because every crisis, valuations never make the market bottom. It is the policy action which makes the market bottom. Like 2008, it was government's idea to recapitalize foreign banks that stemmed the fall. Post-COVID, every central banker cut their rates and that stemmed the fall. Do you think somewhere it's a matter of 15-20 days that a big policy action could come?
Big policy action is already happening. As far as India is concerned, if you look at the Reserve Bank in the last couple of months, almost 6 to 7 lakh crores of liquidity injection has happened, close to 2.5 lakh crores by way of bond purchases by the Reserve Bank. So that is the durable liquidity. The CRR has been cut, and I think that will continue. As you rightly said, given the amount of disruption that is there in the global markets right now, I expect the central banks across the world to take major policy actions in the next 2 to 4 weeks, and that would include Fed taking some measures, whether it is a cut or whether it is liquidity injection. I believe Reserve Bank will continue to guide the market and calibrate its policies to address the ongoing situation. So yes, we are very constructive on the fixed income at this point in time.
So where do you see the 10-year eventually settling? Could it go below, could it go to 5.5? Could it go to those levels?
Now, at this point, I think that is a very optimistic outlook. I think currently the 10-year yield is at around 6.5%. We will take it one step at a time. I think the next stop is 6 quarter. And if I look at the valuation from a historical perspective, I think somewhere between 6 to 6 quarter is where we should find ourselves in the next 6 months. And then, 5.5, we'll take it from there, because it will depend on how the situation evolves at that point. So let's say if as everyone is saying that India is in a relatively stronger situation for two reasons, I believe. One is that our government has taken a reconciliatory approach and not a contradictory approach to the US stand, and therefore we are in a very strong position to negotiate and come to a mutually acceptable bilateral trade deal. And the second is that as far as India is concerned, the gap between what is required to be done to meet the US expectation and where we are is relatively narrow. And therefore, if we open up a couple of items like cars or defense to a more liberated import regime, then we should be in a good position. Obviously, the Indian markets will have to compete with countries like Vietnam or Taiwan, who may be more willing to reduce tariffs on an accelerated basis. So I think given the fact that India is in a relatively strong position, crude is low, inflation is low, 5.5, God willing, yes, but I think we will want to go one step at a time for the next 1 year.
It's so good having you on the show. Thank you so much for your time as always.
Thank you.
If you like this video, then like, share and subscribe to ET Now.